Welcome to this mid-year market and economic outlook. In this video, we'll discuss the key themes from the first half of 2026 and what has driven strong market performance. There's a saying that smooth seas do not make skillful sailors. The first 6 months of this year have certainly tested that idea. Investors navigated a war in Iran, oil-driven inflation, and ongoing questions around artificial intelligence. And yet, markets climbed to new all-time highs, corporate earnings grew at a double-digit pace, and many asset classes delivered strong returns. Over the next few minutes, we'll walk through a few major themes that could continue to drive markets in the second half of the year. To start, let's take stock of where we are in the business cycle. The current expansion began back in April 2020 during the depths of the pandemic. That means we are now in the 7th year of this cycle, which may surprise some investors given how many times a recession seemed possible along the way. As this chart shows, some business cycles have lasted a decade or longer, including the recovery after the 2008 financial crisis and the expansion of the 1990s. The fact that we are still growing speaks to the resilience of the economy. Today, the picture is broadly positive. Inflation is elevated, but may be near its peak. The job market has strengthened again after last year's slowdown. Business investment has picked up, and consumers continue to spend even while feeling cautious. These are historically supportive conditions for financial markets over the long run. Next, this chart shows how a wide range of asset classes have contributed to positive portfolio returns so far this year. The second quarter was particularly strong across the board, in part because markets began recovering at the start of April following the initial shock of the conflict in Iran. Corporate earnings have also been a major driver, with profits for S&P 500 companies rising more than 20% over the past 12 months. One other notable development is the wave of high-profile IPOs, including SpaceX, with listings from OpenAI and Anthropic anticipated. While these attract a lot of attention in the short term, what really matters is how these businesses perform over years and decades. That is where the real value for investors tends to emerge. It is worth noting that U.S. stock valuations are elevated, with the S&P 500 trading around 20 times earnings, above the long-term average of about 16 times. While that does not tell us what markets will do in the near term, it is a useful reminder to stay balanced across asset classes. Turning to inflation, the conflict in Iran disrupted oil supplies through the Strait of Hormuz and pushed Brent crude to nearly $120 per barrel earlier this year. Headline inflation, measured by the Consumer Price Index, climbed to 4.2% in May as a result. However, core inflation, which strips out food and energy, remained at 2.9%. Suggesting that the broader price environment has actually been more contained. The good news is that oil prices have since fallen back to around $70 per barrel, and economists are cautiously optimistic that inflation may be near its peak. This pattern is consistent with other past geopolitical shocks to oil supply, such as Russia's invasion of Ukraine in 2022. Once conditions stabilized, prices and inflation rates often came back down over time. Next, let's talk about market volatility. It's often the case that how we choose to respond to it matters more than the volatility itself. The VIX index, a common measure of market volatility, is currently below its long-term average. As this chart illustrates, periods of elevated volatility have also created opportunities for long-term investors. The S&P 500's largest pullback so far this year was about 9%. Declines like that are never comfortable, but markets have not only recovered, but have gone on to reach 24 new all-time highs this year. The investors who benefit most are those who resist the urge to exit during these difficult moments. Finally, one consequence of market uncertainty over recent years is the record level of cash sitting on the sidelines. Money market fund assets have now reached $7.9 trillion, more than double their pre-pandemic level. While cash can feel safe, it comes with a real cost. With headline inflation running above 4%, the purchasing power of cash is actually declining in real terms. Even when short term rates appear attractive on the surface, they often do not keep pace with inflation over time. This is why maintaining a balanced portfolio that can benefit from growth, income generation, and capital preservation remains so important, especially as the market and economic cycle continues to mature. We hope you found this first half review helpful. If you would like to discuss any of these themes or how they relate to your portfolio and financial plan, please don't hesitate to reach out. We look forward to speaking with you.